Welcome to Taking Stock for the week ending the 10th of June 2022. I'm Kien Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Great to have you on board, Jace.
Thanks for having me again, Kien.
But before we get started, we want to remind you that the information provided today is of a generic nature and therefore should not be considered personal advice. Any tables and charts presented today are based on historical data and should not be relied upon as a guide for future performance. And of course, the biggest issue to hit stocks this week is the RBA raising the cash rate to 0.85% from 0.35%. This was above expectations, with half the number of market economists anticipating only a 25 basis point hike. So the market is now anticipating that the RBA will lift their cash rates to around 1.35% by July in an effort to curb inflationary pressures.
Yeah, but despite investor concerns, the RBA Governor Phil Lowe stated that households and business balance sheets are in good shape. And this provides the central bank some confidence that the Australian economy can withstand higher rates. From the chart on screen, business conditions remain above the average, while household consumption rose strongly from the COVID trough.
Yes, Jay. So what does this mean for the share market? Well, historically, when you have rising interest rates in the low environment, it tends to be positive for equity markets because it suggests improving economic activity. But in this case, interest rates are expected to rise quite steeply to combat inflationary pressures not seen in the last decade. There are now fears of stagflation, meaning high inflation with low economic growth. And this has led to compressed valuations across the market since, especially over the last 6 months, with the All Odds index PE level trading below its long-term average at around 15.4 times now.
Yeah, that's a really interesting thing, Kien. I mean, the fall in market valuation has not been entirely due to a market correction. So corporate earnings have risen strongly over the last year, and this has contributed to the decrease in valuation ratios like the PE. The chart on screen compares the All Ordinaries Index in blue with its 12-month forecast earnings trend in black. And you can see that once we dig deeper into some of these corporate earnings, a lot of the upgrades have actually been the result of higher commodity prices in the resource sector, with energy and mining posting the largest earnings upgrade since March 2022.
Yeah, that's right. So at this stage, the economy remains quite strong with low unemployment and rising corporate earnings. And much of the volatility in the markets has been caused by macroeconomic factors rather than fundamentals. Inflation has been driven by supply issues, which has led to a commodity-driven boom. And Australian equities are better placed than many international markets to weather the current market cycle with its overweight exposure to resources and materials. In addition, we expect commodity prices to be supported by further economic stimulus in China following recent COVID lockdowns. So investors who want exposure to resources can use the Stock Doctor filter. Just generate a list by selecting our star stocks within the materials and energy gig sector.
Outside of these sectors, Ken, potential investment opportunities also lie across healthcare, technology, and the industrial sectors, which many have been sold down despite the resilient earnings expectations and strong fundamentals. And a lot of Lincoln Star growth stocks are in this bucket. You can generate a list of opportunities by running a filter containing star stocks, 6-month price change, and positive earnings revisions over the last 3 months. Now you can see that some of the stocks on this list include ARB Corp, James Hardie, REA Group, Altium, IDP Education, Credit Corp, and MA Financial, which have all fallen in excess of 30% over the last 6 months.
Let's now return to that earnings revisions chart, because what I notice on there is that discretionary sectors have experienced net downgrades over the last 3 months, although it's been quite small. Intuitively, when you think about this, rising interest rates and high inflation is expected to pose downside risk to discretionary spending. As you can see with the chart on screen, consumer confidence has been deteriorating since the start of the year. And this is an active risk we are currently monitoring across our star retailers, and it's the reason why many of them have been sold down over the last week and 6 months. Some of these star stocks include Breville, Baby Bunting, Lovisa, and JB Hi-Fi.
So using a filter to generate a list of star retailers, we can see that apart from ARB Corp, the majority of consumer discretionary stocks have experienced stable or improving earnings expectations over the last 3 months. Another thing to point out is that not all retailers are alike. We are cognizant of rising consumer risks to furniture, apparel, and electronics retailers like Adairs, Lovisa, and JB Hi-Fi, and we may re-evaluate our positions in these companies if earnings begin to deteriorate. For the time being, companies like JB Hi-Fi may continue to see strong demand for office and work-related equipment, especially as we come towards the end of another financial year. So we're not too quick to discount this retailer right now. On the other hand, stocks like Baby Bunting, who offer products that are somewhat defensive, should fare better than other retail peers. Meanwhile, Breville and Lovisa will need to rely on its international growth strategy to maintain its earnings momentum.
And for income-orientated investors, it's important to assess the sustainability of the dividends. Take, for instance, with Adairs, a homewares retailer. The gross dividend yield of 13% currently looks attractive on the back of share price declines and rising short interest over the last year. However, a look at the earnings trend under Golden Rule 4 shows that their forecast earnings are higher than they were a year ago. Meanwhile, forecast free cash flow is expected to remain well above dividend payments of 19 cents per share this year. For now, dividends appear sustainable, but the impact of rising interest rates to consumer budgets will be a risk, and we will continue to monitor this closely in coming months.
So over the week, we've also noticed a sell down across the banks. Now, previously, we highlighted how banks may benefit from rising interest rates by expanding their net interest margins, which is effectively the difference between their loan and deposit rates. However, for banks, rising interest rates could be a bit of a double-edged sword. We've seen steep rises in interest rates, and that could lead to higher funding costs and potentially bad debts as borrowers could default on their loans. Consumers are also more sensitive to interest rates because over the last 30 years, household debt has actually grown from 40% to 130% of GDP. The concern here is that the rise in bad debts could lead to reduced earnings and dividends.
And also, higher rates could lead to lower mortgage lending as well. But at this stage, the dividends for the banks appear sustainable. Remember, the major banks have simplified their business models away from areas such as wealth management and insurance, which have more volatile earnings. Note that over the last 3 months, forecast earnings have been stable, with most banks expecting to generate growth in this financial year. As a result, the payout ratio remains unstretched at between 60 to 80%. And currently, the banks are on a gross dividend yield of between 7 to 9%.
All right, so looking at the corporate calendar for the week ahead, and we have no star stocks reporting, and none of our star income stocks are due to go ex-dividend. In technical alerts, Cochlear, doTERRA Royalty, and Woolworths issued bearish signals on the SD Max. Meanwhile, Nine Entertainment and Cogstate triggered the SD30 TSR stop loss. Unfortunately, there were no bullish signals observed this week.
In Under the Microscope this week, we look at borderline star growth stock, Technology One. Now, Technology One is a provider of cloud-based software which enables businesses to manage daily activities such as accounting, payroll, and business analytics. And about 78% of its revenue is reoccurring. And that's driven by a defensive client base in government, education, and health.
So the investment thesis in this company is driven by the innovation through product enhancements, coupled with the planned expansion into the UK market, which is 3 times larger than the Australian market. In addition, it is in the process of transitioning clients to the cloud, and this should deliver improved efficiencies and greater scalability within the business.
Jace, I noticed that the financial health dipped from strong to satisfactory in the last result. Being a technology company, it's no surprise to see a high intangible asset base at around 40% of total assets. In addition, subscriptions are usually paid up front, meaning that revenue and services are deferred and accounts for around 59% of its liabilities. We do not view this as a significant risk although we will be monitoring other areas of financials, such as the capitalization of development costs, which can lead to artificial earnings growth.
Moving forward, earnings growth is expected to be in the middle double digits, and this is to be assisted by the recent acquisition of education scheduling platform provider Sentia Resource Management. Despite the positive earnings revisions, the stock has been sold down over the last 6 months, and this is on the back of the rotation from growth to value. This could also represent opportunity for investors who believe in the strong fundamentals of the business, although trend-sensitive investors should remain on the sidelines until the SD Max moves into a bullish trend.
Yes, Chase, and the founder, Adrian DeMarco, has a 5.4% stake in the business, but has recently announced that he will be standing down from the company later this month. The current deputy chair, Pat Sullivan, is planning to take on the non-executive chair role, and we believe the management transition will be smooth, given that Pat has over 30 years experience across a range of industries. This week, for income investors, we asked the question, do rising interest rates impact the performance of listed property, otherwise known as REITs? To understand this, you need to look at the overall impact of both rising interest rates and inflation. Typically, high or rising inflation can be a potential tailwind for REITs, as property values and rental income are usually tied to the inflation rate. Of course, this differs from REIT to REIT depending on how they structure their rent. For example, Arena REIT has 90% of its financial year 23 lease arrangements tied to the CPI.
On the other end of the spectrum, REITs tend to also have higher gearing levels. Hence, higher interest rates increase the cost of borrowing and potentially lowers earnings as well as the amount of dividends that it could pay to shareholders. Now, of course, the full extent of higher borrowing costs would depend on the proportion of fixed and floating interest rates. Another side effect of rising interest rates is that it could lower property valuations.
But from a share price perspective, rising interest rate expectations has historically led to lower relative returns for the REITs. And you can see this with the chart on screen, which compares the government bond rate, a proxy for interest rate expectations in blue, with REIT outperformance since 2001. Throughout history, you can see that the REITs struggled over the periods when bond yields are rising, highlighted on the chart.
And that's a very interesting chart to refer to, Kien. So to summarize, market sentiment across REITs tend to be weak in a rising interest rate environment, and this is due to the perception that REITs will be faced with higher cost of debt and also lower property valuations that may offset the benefits from any rental increases. This is also the reason why the listed property sector was the worst performing last month.
But for the time being, we do not see any threat to the sustainability of the dividends across our star REITs, which are trading at dividend yields around 4 to 7%. And these REITs have long weighted average debt to maturities. They also have high occupancy rates and other avenues for earnings growth within childcare, for instance, with Arena and Charter Hall social infrastructure, service stations with Waypoint, and high-performing industrial assets such as Bunnings. In fact, Arena just updated the market, suggesting that the asset valuations remain quite strong.
So with REITs expected to go ex-dividend at the end of this month, the share price weakness across this sector may represent opportunity for some income investors.
That's all we have time for today. Again, thanks, Jace, for your contributions.
Thanks, Kien. Hope you enjoy the long weekend.
And speaking about the long weekend, a reminder that Monday is a public holiday with the Queen's birthday, but we will be running our Lincoln Live session on Tuesday. And that's a forum for you to ask our Chief Investment Officer, Tim Lincoln, our portfolio managers, Matt Swartz, and tech guru, Rob Manfrey, and of course myself, any stocks or market-related questions. Remember, rising interest rates could dampen the sentiment on stocks, but the fundamentals across those quality businesses remain sound. Take care and have a happy, healthy, and prosperous week, everyone.